And on today's show, how to design life insurance for tax-free income. Part one of this week's series, Life Insurance for Tax-Free Income, with co-host and nationally recognized product expert, Mike McLaughlin. Hi everyone, I'm Steve Savant, syndicated financial economist and contributing author to Backroom Technician and Insmart. Let's get down to business. Welcome to the show, Mike.
Great to be here.
Well, we're talking about a whole nother idea, and you know, the last show that you and I did, we were talking about all the anomalies in the annuity market. Now we're going to be talking about income, tax-free income, if it's designed right. So I just want to go to our script immediately and talk about why we think this is such a big deal. And I think it is. When you look at the taxes, what we're talking about, and everything's going up, this is a big deal. And we're talking today, just to make sure we're all on the same page, non-qualified, non-modified endowment contracts. So I just want to make sure when we talk about this, and when you talk to your client, you need to say the same thing. If you're not dealing with a qualified plan, that phrase will keep you out of E&O land. So I just want to make sure, and here's our caveat for the show today. The withdrawals of basis and the policy loans of gain or basis from a non-modified endowment contract kept in force for the life of the policy insured will be treated as tax-free distributions under current law. Now, think about this. There's a few other things, Mike. I'm thinking of like reverse mortgages are tax-free. Some municipal bonds are tax-free. A Roth IRA. So there's some other cousin, financial document products that are kind of similar to this.
There are a lot of different ways to skin a cat, obviously, but this is very efficient, both from a taxation basis, from a protection basis, most importantly, as well as a lot of other caveats that we're going to be talking about this week.
Well, let's walk through these three. These are the three impact players. We've had regulation. The regulation, really, we talk about having heavy regulation in the 21st century. Actually, the heaviest regulations I remember, been in this business 30 years, are what happened here. Talk a little bit about 1982 TEFRA.
Well, I think that when you take a look at these three significant tax legislations, you're looking here at the first one in terms of defining first in, first out basis. And really a key and the basis versus the gain, and then how do you manipulate that in order to get tax-free money out from that gain scenario. Here we're trying to figure out what is life insurance and what's not life insurance, what's an investment. That argument, in my opinion, still continues in Congress today as in terms of trying to attack not only cost or corporately owned, but just life insurance values as well. And one thing that I think that it's important for all advisors is that they have to be very supportive of all of our industry lobbyists, because all of these different things are continually under attack, obviously always in demand.
So when we're thinking about it, FIFO and LIFO, the definition of life insurance on different, and TAMRA, how much money can I put in based on the ratio? Either I'm using the guideline annual,
how much leverage,
or the cash value accumulation test, which will be more on that later. Now I want to say something about why do I want to bring up this thing about, Steve, we're selling insurance, but actually if we're selling saving vehicles, there's many chassis to be involved with. So I want you to look at this because I think it's something that I think we're going to get into, which is, are we going to start taking a risk tolerance test for our clients? Because we have multiple mortality chassis, and I've just done, this is the actual result, a risk analysis. It's about a 5-page, it'll probably take you about 10 minutes to go through it. And in this case, we add up a score and we come back to the client's risk profile and says he's very conservative. If he's very conservative, I might look at par. If it's kind of just conservative but not that much, I might look at par or current assumption UL. There's different reasons of why we're going to go this way. But we're now doing risk tolerance because people, and Mike, you see this all the time in the annuity department, should I do index or should I do variable annuity?
Yeah, and I think it's important also that this type of risk tolerance test really needs to be done every 3 or 4 years at a minimum for people to take a look at what is their overall portfolio and where does the life insurance cash value fit into their overall risk tolerance, because we know as financial planners that changes over time and it changes due to specific family events that always needs to be rechecked and reclocked.
Yeah, we all change our opinion. I don't know, after 2008, I saw a lot of people turn conservative.
Yes, absolutely.
Well, let's look at the 4 mortality chassis: participating whole life, current assumption universal life, index universal life, and variable universal life. Now, there's 2 ways on participating whole life. If you do the complete base, it's about as conservative as it gets. Dividends are not guaranteed, but you could use a combination, stealth combination of term rider and paid up additions rider that can drive that number up higher. Now remember, the term rates are current company practice, but it's a little bit way, you got 2 ways to go. Current assumption universal life is kind of taking a back seat in these days, Mike, because of the interest rates.
Certainly interest rate is a challenge, but when your client is looking for flexibility, but the opportunity to give a conservative investment and really kind of talk about that 1988 tax law and max fund something, that gives you a lot of flexibility in the planning process.
And keep in mind, some people think that if we start to move up in interest rates, that current assumption universal life will have a quicker way or an easier way to actually apply the new rates rather than the participating or the traditional mutual companies.
Most likely so, yeah.
Now, indexes, of course, this has got to be the hottest thing in income right now. I can do foreign, I can do domestic indices, and index universal life. And there are some major players in this, and actually, in my view, when we might talk about this on Friday's show, there are about 3 or 4 players that I think are huge in this arena. Talk a little bit about the difference. Why are people looking between, I have a security here and variable universal life, and I have an indexed option? These are options now. If I'm already a moderate to moderate aggressive or aggressive, if I'm aggressive, I might be looking at VUL.
Absolutely. If you're an aggressive investor, you probably need to be in a variable annuity to take that risk, be rewarded for potentially higher returns, being invested in stock market securities, combination of bonds, and that's where that risk tolerance really comes into play in terms of setting up your model allocation. But from an index option, that's also growing in popularity because there are so many uncapped indices that started out on the annuity side, transitioning over onto the life side right now, where you can take a small spread and have unlimited upside potential. Gives you a great opportunity to have stock market type returns, but without any downside risk year over year.
Keep in mind, again, one of these 4, I don't know which one it'll be. Once I do the risk tolerance test, I'll have a pretty good idea. When we come back from the break, we're going to talk more about how we're going to set up the design and how this can make your policy the most effective and efficient for your client's rate of return. It's not how much money you make for your clients, it's how much money they get to keep, especially in retirement. But retirement income could cause Social Security benefits to be taxed. One tax advantage alternative is life insurance designed as a non-modified endowment contract that can generate tax-free income without taxing Social Security benefits. These contracts offer differing funding options depending upon your client's risk tolerance. For more information on how life insurance can be part of your retirement planning, just email me at steve@downtobusiness.tv. Brought to you by Ash Brokerage, the practice enhancement company. Well, welcome back to our second segment. Of course, I'm with my co-host today, Mike McLaughlin. Mike, I like you being the co-host rather than just being the guest.
It's good to be stepped up.
Hey, we're standing for today because we have a lot to talk about, and sometimes it's easier for us to just kind of use the Mondo pad in a standing position. There's only one real place we can manage costs. I can't change the admin policy fees. I can't change the premium loads. A lot of those things are just static. But what I can do is manage the cost of insurance. Remember, if you do this correctly, this is probably probably the most significant product out in the United States, especially for high tax bracket clients, and especially for people who don't want to see their actual retirement income actually dicker with their Social Security. More on that throughout the week. Let's talk about this. We're managing the cost of insurance. We have to determine what's the contribution period and what's my contribution amount. And once I get that done, I start going down gender selection. Now, most people just go and punt to the male, but Mike, why should we look at the female or maybe even a surrogate?
Yeah, I think that you take a look at, the really only cost drag inside of this is the cost of insurance. Females obviously have a lower cost of insurance because of longer life expectancies, but I think you also have to take a look at, whether it be male or female, which is going to impact that policy the least. If we have a very healthy male and an unhealthy female, then we have to go to that. And then also in a corporate situation, we can look at surrogate with some group contracts underneath that. So there's a lot of different ways, but you really need to manage that cost and look at how much drag that would create in the cash value.
And remember, since we're trying to purchase the lowest possible death benefit according to TAMRA, we're really, once we get down that far, we're looking at justification issues for a surrogate. It's going to be pretty marginal because really we're so low that most insurance companies within the blood family, immediate family, are going to be okay with us using a surrogate if we have to go that far.
Sure.
Guideline annual versus cash value accumulation test. Every time I do an income, Mike, I do both tests because I never know. Usually Guideline's going to win, but I'm too afraid not to at least look at CVAT or cash value test. Talk a little bit about that.
It just takes 30 extra seconds to run a second illustration. Why take the chance? It could blow up on you down the road. You want to have the most flexibility and jump into the most cash. that creates the best cash value. So take the time from an illustration standpoint to take a look at all possible situations.
And then, of course, we're looking at level versus increasing. The same thing again. Actually, I do, as you just suggested, we do several iterations of this. Like male, female, CVAT guideline annual, level, increasing death benefit. I need to see it all before I determine who I'm going to select as my insured. And then, of course, if we do use increasing or some of these ideas, we want to reduce the death benefit again and option switch. And Mike, I'm not really ready to wait for retirement for that to occur. I might do that as soon as the guidelines let me do it.
Absolutely, yeah, and there's different options here. And this is where getting into the planning process really helps, because when you're taking a look at high wage earners, maybe there's bonus opportunities in 5 or 10 years that we may have to bump up that increasing death benefit for the period of the first 7 years. Then we don't need it. We can turn off to a level. That's the kind of knowledge that you need to pull out from a family situation to make sure that you set up the case design properly.
I've been managing this issue for 15 of my 30 years of my career, and I have to tell you, this is going to have an impact on our internal rate of return. I want to look at some of these other things. Current company practice. Now, we all have cost of insurance. We all have their policy fee, admin costs, premium load. This could all change, though. It's current company practice.
Yep. I always like to say, we buy our bonds from the same place. We have the same mortality. Best place to look is past experience. How well did that company treat their policyholders year after year after year? Well,
you actually bring that up in our third part. If you look at the difference between current company practice and the contractual guarantees, that's a huge issue. And you just brought up the historicity. Look, I know certain par companies who have 11 to 12,000 dividend scales. So are they actually starting over with the new portfolio, charging a new cost of insurance and not retroing that back? I mean, there's a lot of issues on the history. But think about the disparity between current company practice and contractual guarantee. There's some embedded value here. I remember the days when Lincoln Benefit was around. They did zero net cost loans, contractually guaranteed in the policy day one. So their current and their guaranteed was the same. That's a huge issue. When you get down to who's got the best current policies, and I like to look at contracts devoid of their performance issues. I just want to look at the expense loads. This becomes a really good way to measure, is this a good deal? And of course, on our policy loans, Mike, we have a choice between fixed and variable. There's a lot of argument here depending upon the LIBOR rate, but talk to me a little bit about that.
Yeah, you take a look at today's current interest rate environment. Yeah, it's very cost efficient on any type of loan, but depending upon how long that's going to be outstanding, if we're using this for income planning and have a 20-year retirement period or a 20-year payout, variable rate loans that can really go up, that can really change the dynamic of the cash value you need in and create some drag. So again, all those types of variables need to get into the consideration of what's actually happening with the client.
Well, when we're talking about this, we're talking about the income period. This is kind of like the accumulation period. When we're talking about income, I have 3 choices here, and I just want to bring this up because people only look at the 2. I have withdrawals to basis. That's pretty straight up. Remember, the force-out rule, the Tamara Corrections Act, governs the first 15 years of any contract dated after 1988, June 21. So you want to really look at that. But since everybody's pretty much past that date, withdrawals to basis, policy loans of gain, you want to look at that. But remember, internal policy loans of interest, because I don't know any client that has been paying the annual interest. So if I not only have constructive receipt of policy loans I took with my income, I also am going to have constructive receipt inside. If that policy ever lapsed, we'd have a phantom income tax on that. So it's critical to keep this in force.
Absolutely, yep.
And then last, look at this potpourri of different, it always goes, how much does it cost? I don't know, I have to read the contract. And remember, we also are dealing with current company practice versus contractual guarantee. Zero net cost loans is the charging and crediting of the same rate about 31 days to 60 days apart depending upon the carrier. Only a few carriers are left that actually offer this. Many carriers are doing wash loans, the same spread loan, it's the same crediting, same charge, 365 days apart. Heads up here, not many illustrations actually show the accrued charge over the year because of the time difference. You may get a little bit of an accrual charge here. It never shows up in an in-force ledger that I've seen thus far, but just a heads up, you're going to look at kind of an erosion, small, maybe 10, 15 basis points, but it could happen. Spread loans, Mike?
Yeah, and again, I mean, you take a look at all these different things here in terms of spread loans, of having, what's the difference, and then the impact in the cash value. And again, it goes back to whether it's fixed, variable, all types of situations that you can play in there. Going back to direct recognition and participating loans, again, just a whole potpourri of a way to manipulate the policy and get loans out. But again, you have to be careful about what's the long-term impact of the cash value 10, 15 years down the road. Not just what has happened now in the first 10 years, but what does it look like in 15 to 20 years?
Yeah, direct recognition loans, just be advised. Remember, it could be punitive. You need to look at the in-force ledger, and if you look at a par company with it, you need to demand that it actually reflects direct recognition loans. They won't do it automatically. You have to ask for it so you can actually see what you're paying for. Participating loans, Mike, indexing. This is where this has become huge.
Yeah, and again, when you're participating in an index, boy, a variable payout, maybe zero, that could really backfire at some point in time. Zero is your hero in terms of cash accumulation, but that could also be very impactful with a loan rate and the zero participation.
Well, that's all the time we have for today. Remember, before moving forward with any of the ideas on our show, always consult your tax advisor, legal counsel, or your broker-dealer compliance officer. Missed an episode? Just go out to our site, downtobusiness.ashbrokerage.com. Want to email me? steve@downtobusiness.tv. And remember, you could be wiser as an Ash Brokerage advisor. I'm Steve Savant for Mike McLaughlin. We'll see you tomorrow.